Welcome to CISSP Training.
Now, risk management is getting very important in the industry, and because of that, the CISSP exam is covering risk management more than it used to. It even changed the name of this domain, added risk management to the name. So we're really going to go into different parts of risk management because not only are you going to get tested on it, but it's something that people don't fully understand how to do. And it's not vulnerability testing. Vulnerability testing just means you could find the holes. It's easy to do that, and then you associate them with threats, and then you've got to calculate the risks. And so we have to look at the people, process, technology. You know, we've got to look at all of them. And how data is stored, how it's moved. We've got a lot of things that we need to understand. Why is risk management difficult? Why would it be hard to actually carry out? Risk management is difficult because first off, you're trying to read the future. What bad things are going to happen, or what could happen, and how much is it going to cost us? So you're trying to look at the future and understand what can come down the pipe and hurt us. But you also have to look at so many different variables. Like I've been saying, there's administrative, technical, physical controls, there's operation, tactical, strategic. There's risks that can happen at each one of those layers. There's a lot of variables that you have to understand if you're going to develop a risk management program and understand how to map those to the right control. So we need to gather information. Now, if you've done any risk management, you know that the most time-consuming thing is to gather the information because you have to interview people, you have to do surveys and collect all of this information. So risk management is a difficult process, but there's a lot of best practices, there's a lot of proven models out there, and it's becoming critical in the industry that more people really understand it. Now, one thing that is the biggest question for all organizations is what is enough security? Because you have, a budget, you only have so many resources. You can't secure everything to maybe the degree that you need to. So what's the enough security? What's our acceptable risk level? And we need to think of a few things. We talked about the legal issues. We talked about the regulations we have to be compliant with. We need to look at our assets. What is it that we have to protect? How valuable are they? What type of adversaries do we have? How motivated are they? What is their motivation? So all of this is kind of, we do like a threat analysis to figure out how much is enough security. It's a balance. It's a cost-benefit of balance, and we're going to look at some of those formulas. Now, when you're putting together a risk management committee or a team, this is the group who's going to collect the data and then going to analyze the data to figure out the organization's risk level. Now, what if you had on this committee everybody from IT? That was the whole team. They would only understand risks and vulnerabilities in IT. They wouldn't understand business issues in HR or at management levels or capital issues. Everybody understands their own piece of the world. So the committee that's going to do the risk management needs to be made up of people from all over the organization because they'll understand their pieces of the pie. They'll understand their departments and the type of risk that can happen there and negatively affect the company. So you put together, it has to be the right team. It not only has to represent the different departments within the organization, it has to be the right level of people who can actually make a difference. So that means that you don't put people who have absolutely no say or control in this team. A lot of companies have just given up, said, yeah, here's Joe, he'll represent our organization, and he's a clerk or he's not management. the right team is necessary because they're going to have to not only understand risk management methodology, but they're going to have to help enforce or make changes in the culture, which is the hardest part of security. So there's a process to setting up a risk management program, and a lot of companies will think they have a risk management program, but really they have a vulnerability management program. So we're going to step through each one of these pieces of how to set up a program, what it means, and then what do you actually do with the information that you find out. So we talked about the team that we're going to put together. It's going to be from different departments. IT, auditors may be involved, physical security, business people. We're going to get this team together. Now, one thing we don't want to do is constantly be in meetings. And I've worked with companies who try to put a risk program together and they don't move anywhere, but they meet all the time. And the reason that they don't move anywhere is because they don't really understand how to set up a program. They just get together, they talk about all the problems in the company, and they don't lay out a process of 1, 2, 3, 4. This is what we're going to do. So it's actually a good idea to maybe have a consultant or an expert from the industry to work with the people in the corporation to lay out the framework for the program.
Video by Xelmart.com.
Otherwise, people who don't know the methodology, they just all get in meetings and there's nothing interesting or useful that's done. So we also need to know the scope. What is the scope of this risk management program? Is it going to be the whole organization? Is it going to be we have offices all over the United States, all over the world. What type of data are we going to protect? What type of assets are we going to protect? Because in reality, you can't create a risk management program that's going to protect everything, because your planning process will never be done. Usually you chop things up. Now, one thing as a security person I think is very interesting. Most companies think they have a risk management program. When you talk to anybody in the business world and you talk about risk management, they'll say, oh yeah, we have that. They have a business risk management. They don't have a security risk management, and those are two totally different things. So a lot of companies actually leave themselves vulnerable because they're told you need to have a risk management program in place, and they say we do, but it's business oriented. And it looks at, capital and credit and purchasing other companies and the type of products that they're going to roll out. Has nothing to do with the security issues. So it's almost too bad that we use the same label, risk management, for business and security. But sometimes I've had to push business people when they tell me they've already got a program. I have to push them and educate them on the difference between the two, or they're going to be very vulnerable. So we have to develop a scope. What is it that we're going to protect? What assets are we going to protect? And how do we figure out this scope? We just make it up. The team says this is what we're going to do. Senior management is going to dictate that. Senior management will tell the team what has to be protected, and they're going to help determine the actual scope of the assessment. Now, another thing that the team needs to decide upon is the methodology. How are they going to do the risk assessment? And the two main choices are qualitative or quantitative. Qualitative means that you're going to get some experts together and make an opinion-based decision. Quantitative means that it's going to be all about numbers. You're going to use percentages. You're going to use dollar amounts. You're going, when you go to management, you're going to say this type of risk can cost us this much, and this is how much it's going to cost us to protect from that. In a qualitative, you would go to management not with money terms, not with monetary terms, but you would tell them on a rating, this is where our risks actually are. Now the industry is getting more risk management tools out there because the industry is requiring it, because regulations are requiring it. So tools are great for risk management because they already have like built-in scenarios, they already have the built-in formulas, they could have been built-in surveys that you're going to ask the people to submit. So they reduce the time of gathering information, and they can run the same data through different scenarios, because we're not looking at just one thing. Maybe there's a tornado, maybe there's a fire, maybe we're going to get hacked into. There's a lot of different things that can happen. But on a personal note, I need to warn you about the tool that you purchase and put in place. Somebody who actually knows about risk methodology should be making the decision or helping you make the decision. I've worked with several companies who have bought a risk management tool because it was very impressive. It had all these formulas and it had all these calculations, and it wasn't right for them. It has to be right for your environment, qualitative or quantitative, and it has to make sense. There are tools out there right now that I think are just for show. They don't actually provide any value. So on a personal note, this isn't CISSP oriented, before you buy a tool, really investigate, because this is important. You're actually determining the risk level of the organization and the amount of money that you have to spend to reduce this risk. So this is pretty critical. Now, I talked a little bit about the acceptable risk level of a company. And acceptable risk level, what does that mean? Well, every company has a different risk appetite. That means how much risk they're willing to take on. Now, when we talk about risk appetite, that usually is meaning in the business world. Businesses that have a high risk appetite means that they're going to take on risks. They're going to be on the bleeding edge. They're going to not be conservative. In security, we usually don't use the risk appetite as much as an acceptable risk level. And that's where how we know what is enough security, because an acceptable risk level has to be set. But how do you know, how do you define that? Who comes up with the acceptable risk level? Well, we talked about the drivers that go into setting up a security program, which are the legal issues, regulatory issues, threat profile, all of these things, and the business drivers. So those things are going to help determine the type of risk that a company can take on. And management actually has to set it. Management sets the acceptable risk level, not the team. They can bring this information to management and help management set it, but management needs to make set the line. And that's how we know we can accept risks up to here and not over. And this is where we get what's enough security. So, but it's very abstract. So where is this actually documented? The acceptable risk level. Is that written in some document somewhere with that label? No, it's not. You should set that and then develop your policies. Your policies should reflect your acceptable risk levels, and then your other things under the policies just get more granular that will indicate how you're going to stay under or within that acceptable risk level. So every company has a different acceptable risk level. A grocery store compared to the NSA, huge difference. And that's going to be determined on their threat profile. What type of enemies do you have? How motivated are they? What type of assets are you protecting? So somebody needs to be involved with helping management understand the security risk level that a company is under. Again, I work with companies that they don't know what this term really means. They don't know how to set it, and they don't know what is enough security. So they end up spending too much money or not enough money and don't get the right countermeasures. But you won't, because you're going to learn what needs to be put in place. Now, one thing the team is also going to have to do is determine how are they going to collect the data. And this, like I said, is the most time-consuming part of risk management, because you have to collect all this data, which is called an assessment, and then you have to do an analysis on it. So you
Video by
get
Xelmart.com.
the schematics of the network. You get information on the type of data, where the data is, the type of security components that are in place. And then you have to look at some of the business issues that can be affected by security. So how are we going to get it? And a lot of it's through surveys. You can interview people who would know specifically about security information. You do vulnerability tests, you do penetration tests. You do this and you get this whole big glob of data. And then you have to separate it out and know what it actually means and what to do with it.
Video by Xelmart.com.
So, a big thing is, what are we protecting? What are we trying to protect? You have to identify the assets you're going to protect, otherwise you don't know where to start from. And as I said before, within corporations and even the government sector, the main asset that we're protecting today is data. Because our financial information is digital. All of our information is basically digital. Social security numbers, bank accounts, all of this. So, but that's not all that has to be protected. So that's the first thing we have to list, is what assets are we going to have to protect, and determine what type of risk level that they're at. Now, I said that we have to identify the assets that are to be protected under our risk management model. But there are tangible and intangible assets. When people think about assets, they usually think about hardware, systems, servers, those types of things. Those types of things do need to be protected, but it's usually the intangible things that we have to protect more. Data, reputation, those types of things, because systems, the hardware, cost of hardware has gone down so much, replacing it is not as hard, but replacing data, customer information, or how do you replace your reputation? Intangible things are harder to protect, but the group who's developing the risk management program needs to look at the tangible and intangible assets that will be within the scope of their program. Now, how do you assign a value to an asset? If I buy a server, let's say I spend $3,000 for this server, is that the value of that server to the company? No, that's what I purchased for it. But there's a lot of things that go into determining the value of an asset for a company. It'll be what how much you paid for it. A big thing is what the role is within the company. If it is a server, if it's something that everybody has to contact continuously, then that has a role that's different than if it's a file server that sits in the back that nobody really has much to do with. It's more critical. You have to determine the criticality of the asset. So we'll look at how much it costs, the criticality, how much it'll cost to replace. A big thing is that a lot of people miss is our adversaries. We may not think an asset is very important, but what if somebody else got a hold of it? Now the value of that can actually go up. So another issue is liability. If this asset was compromised, tangible or intangible, what are our liabilities? What are our penalties? So assigning a value to an asset is not a straightforward thing. There's a lot of things that go into that step. And when we're looking at asset value, we need to look at, if something happened to it, how would that affect the business near term, means right away, and long term? So, and that really has to do with the criticality of the asset. Most environments will have, let's say, servers. based upon
Video by
criticality.
Xelmart.com.
They need to. So let's say in our network we have 7 critical servers at the high level. The next level we have 10 servers. The following level we have 12. Now, we need, the reason that the 7 are at the highest level is because if something happens to them, that's going to cause the most damage for our company. And we have to make sure those are going to have more controls and be monitored more. They have to be up and running. So we need to look at the near-term issues, but also the long-term consequences
Video
if
by
an asset is
Xelmart.com.
compromised. We also need to identify the vulnerabilities and threats. We talked about what a vulnerability is, which is a weakness or a lack of a safeguard. Now, safeguard, control, countermeasure, those are all the same thing. I don't know why we don't just use one word, but a safeguard, control, countermeasure, all the same thing. So a vulnerability is a lack of a countermeasure or a weakness.
Video by Xelmart.com.
And in the assets that we're protecting, we've got to look, what are the vulnerabilities? What are the holes? What are the things that somebody can exploit? Then we need to identify the threats. Remember that you don't care about a vulnerability unless there's a threat that can exploit it. Now, the thing that actually would exploit a vulnerability is called a threat agent. So the threat is that somebody's going to find a vulnerability and exploit it. What actually does the act, what exploits the vulnerability, is a threat agent.
Video by
So we need
Xelmart.com.
to go through and look at all the vulnerabilities, whether it has to do with physical security, malicious code, employees sabotage. That's a big thing within itself. Now, I talked about we have to determine what methodology we're going to use. Now, there's different frameworks that we'll look at. There's Octave, and there's NIST has best practices on doing risk management. But the big question is, are we going to do it qualitative or quantitative? And the answer usually is, what does management want? Management would love to have things in numbers and in monetary values, because that's how they speak, and that's what they work in, spreadsheets and how much things are going to cost. Now, at one time, probably 3 years ago, I was very I was a big advocate for quantitative. It has to be quantitative because it's business. It has to be monetary because that's what business wants. But doing a quantitative, a purely quantitative analysis is very difficult. It's very time consuming. And what I have found is that a lot of quantitative analysis that people carry out, they actually they don't make any sense, because it's usually garbage in, garbage out. Now, that's not CISSP oriented. CISSP, what you need to know is the difference between quantitative, qualitative. Quantitative has to do with monetary values and using percentages, and then qualitative is opinion-based. So let's look at a qualitative. And this is the most commonly used in the industry. You have a group of people that are quote-unquote the experts, and that just means that they're most familiar with these types of risks. And you come up with scenarios saying, if a hacker got into our database and got it to our social security numbers, how bad would that be? And they have to rate things. So the experts will rate the level of threat or the level of risk. So we have qualitative, which is just opinion-based. And you can see an example here where, and this is very common, where you have the different boxes with the different colors, where you have high risk and low risk. And usually there's little dots to indicate what you're identifying as risk and which category they fall into, which means which ones do we have to deal with first. So the significant risk is what we would have to put money towards and efforts towards fixing, and then we can get to the other ones. So this is a very common way of illustrating qualitative data on risk management. And so again, qualitative is we get the experts together, we develop risk scenarios, and they'll rank them. They'll rank how this risk, is it a high risk, medium risk, low risk? And they'll also do the same thing about the countermeasures. You need to talk, they have to determine what countermeasure do we need to put in place. Now it's kind of difficult. This is what the exam lays out. You get the experts together, you lay out scenarios, you rank the threats, and you think, well, I've never really seen that happen. But what this means is maybe you bring in security experts and they're going to find out your risks and rate them, or maybe you have a security team already. They're the experts and they're going to do it. But the exam will actually want you to understand these individual steps. Now, what if we needed to get some information in a survey, and some people could be intimidated because let's say you have a group, one of them is a manager and everybody else works for that manager. If you ask that group, what are the problems in the company or what are we not doing right, they're probably going to say whatever that manager wants them to say. They'll be intimidated. So to get honest, real information, it's very common to use the Delphi method, which means that you collect information anonymously because you don't really care who said what, you just need the information. So Delphi is a qualitative process and you're collecting it from people anonymously so it could be honest, it could be direct and more useful. Now qualitative, again, I said it's based on ratings, and it's up to the group on the types of ratings you're going to use. It could be 1 through 10, A through F, high, medium, or low. That would be qualitative. And this is a common example. This is similar to what we saw before of actually using the squares, indicating what's a high risk, low risk. This is showing you a methodology. It's a formal methodology that has been developed in New Zealand, and it's commonly used in large corporations, and it's used for business issues, not just security risk issues. And so if you're looking for a formal risk methodology thing to follow, this is just showing you like the end product, but this is an example of one of the methodologies that are out there. So there's a different approach other than qualitative, which is quantitative. And like I said, this is monetary values, you use percentages, and we're going to step through how that actually works and some of the formulas that are commonly used in the industry. So what's the first thing to actually calculate is a single loss expectancy, the SLE value. And the formula to come up with that is the asset value times the exposure factor. Now, we've talked about the asset value. Remember, it's not just what we paid for it. It was all the other things, how much it costs to replace, what would our adversaries do with it, what are our liabilities if this asset gets compromised. So we cover the asset value. Now we multiply that times the exposure factor. The exposure factor is the percentage of damage we think will take place if this vulnerability is exploited. Because what we're doing is we're looking at one asset and one threat and calculating how much this could potentially cost the company. So on this asset, if this vulnerability was exploited, what would that cost? That's a single loss expectancy. That's just one thing. So, and it's important that you know not only these formulas, but you may be given a simple example where you have to actually do the calculations yourself. Now, what we need to look at also is how often do we think that this would take place? And remember what I said that the risk definition is. It's the business impact and the probability. What is the probability of something of this taking place? And in quantitative approaches, we call that the annual rate of occurrence. Within a 12-month period, how often do we think that's going to happen? So ARO is the frequency. How often do we think that's going to take place? Now the ARO is an annual metric. So if we think it's going to take place one time in a year, the ARO is 1.0. If we think it's going to take place once in 10 years, then it's 0.1, etc. So the ARO is the frequency. It's based on annual, 12 months. If we think it's going to take place 3 times in a year, what would that be? The ARO would be 3. So now we need to put all this together. The single loss expectancy, again, and I'm going to repeat this because I've taught it a lot, and I know that
Video by Xelmart.com.
people miss what we're actually doing. Unfortunately, what a lot of people do is they memorize this for the exam. They don't understand how it really works in the real world. They get their CISSP, but they don't know how to use this information. So SLE means that we have one asset, and we think that if something bad happens, let's say a tornado, this percentage of that asset would be affected. That's
Video
the
by
SLE.
Xelmart.com.
Now we need to look at, well, what's the probability? How often do we think that this is going to take place? That's where the ARO comes in place. So we take that single loss expectancy and we multiply it times the ARO. So what that says is this one asset, if this specific threat comes to be realized and it happens once in a year, we're going to come up with a value. And that's the ALE, the annual loss expectancy. Now, the ALE, what are we going to do with this information? We've gone through these exercises, we've done our mathematics, and this ALE, what does that represent? This is the potential loss that a company can go through if a threat becomes realized. The ALE is the potential loss. Now, I'm going to step outside of CISSP just real quick. Usually you don't do individual assets. You have groups of assets. You'll do all the servers or all the applications or whatever. You don't do every single asset within the company this way. That's outside of CISSP. For CISSP, you do need to know these formulas. I also hope you know what they mean, because you're not going to just see it on CISSP. These are used all over the place. You can find them a lot of information, a lot of resources, and because information security is really leaning towards risk management because it's so important, you need to know this information. So we said that the ALE is the potential loss that a company can endure. So what do we do with that?
Video by Xelmart.com.
Well, this is how we determine what risks we attack first. Remember I said that there's so many risks that a company is going to have to deal with, but they can't deal with them all at the same time. The ALE value is going to help categorize these risks. It's going to help determine the budget that's needed for the security program overall. It's going to tell us, it's a roadmap. This is what we have to do first. This is the potential loss we can go through. This is the potential, or this is the budget that we actually need. That's why we do the ALE. It's not a specific value. So, and what I mean by that is, it's not going to be like you're absolutely going to lose this specific amount of information. It's a guesstimation, because you're looking into the future. So this is potentially how much we can lose. So again, remember I said the definitions between the different concepts within security are important. You have to identify the vulnerabilities. You identify if they have any threats that can exploit them. You calculate the risks, either based on qualitative or quantitative, and that lets you categorize the risk based on importance, on what you need to put money towards first. So let's go through a quick calculation. If we have an e-commerce site and we have a value of $300,000 and we think that there's going to be 40% damage, let's say if somebody hacked in or a virus or something. So we'll just say hacker because that's what most people are interested in. So we have our e-commerce sites worth $300,000, and we estimate that if this exploit happens, that it's going to cause 40% damage.
Video by Xelmart.com.
So the first thing we have to calculate is the SLE. So it's $300,000 multiplied by the exposure factor. So that would be 0.4 because it's 40%. The SLE is $120,000. That's for one time. If it happens one time, we could potentially lose that much amount of money, or that's how much we have to spend to recover. But of course, threats can happen more than once, so we have to figure out the probability. That's where the ARO comes in. We have the SLE, we multiply it times the ARO, which is how often we think it's going to take place. And if we think it's going to take place once, then it's 1.0, and our ALE is $120,000. So what this means is, for this specific vulnerability, we're not going to spend over $120,000 to protect against it. We're not going to spend $300,000 because we don't even have that potential loss. Again, that's how it helps us set our budget for the type of controls that we need to put in place.
Video by Xelmart.com.
So you walk through an example yourself. If we have a facility that's worth $650,000, and if a tornado comes through, we think once in 10 years, and there would be 35% damage, what would the ALE be? So to calculate the SLE, because you can't go directly to the ALE, you first have to calculate the SLE because it feeds into the ALE
Video
formula.
by Xelmart.com.
So our asset, the facility, is $650,000. We multiply times the exposure factor, which is a percentage. We think 35% damage is going to take place. So we come up with the $202,700. Now, we think that's going to happen once in 10 years. Would that be 1.0? No, 1.0 is once in 12 months. So we multiply our SLE times the ARO, and we get the ALE.
Xelmart.com.
So what this means is we're not going to spend over this amount of money to protect this facility from a tornado. Can a purely quantitative analysis be carried out? The answer is no, because if you look at these formulas, the SLE, we have to do the asset value. How do you assign a specific value when you're looking at reputation and looking at what potential adversaries could do and the role that this asset plays within the organization? How do you assign a specific number? And then you have to figure out the exposure factor. How would we know that 35% of a facility would be affected by a tornado? We don't. We do our best. And some people get really frustrated, especially if they're analytical, that these values have to be exact, but we will never know exactly what's going to happen in the future. So a purely quantitative analysis cannot take place. A purely qualitative analysis can't happen because it's opinion-based. So this is why in the industry most analysis take place through qualitative versus quantitative, because it's real hard to put these numbers to how often we think it's going to happen and how much damage is going to take place and come up with a number that makes sense.
Video by Xelmart.com.
Now, there's also different risk types that the group is going to need to be concerned with. And that's delayed and potential. And this is the group that is putting together the risk management program. This is the group that got all the data together, did the calculations, identified the assets. They're still in work. We're still going through risk management process. So we need to look at what are the potential losses and what are the delayed losses. Now, potential loss means what would happen automatically, what would happen quickly. So let's say that a virus got into our environment. We need to look at the type of damage that would cause and the expenses. Maybe we have to call in consultants. Maybe people have to work overtime. Maybe we're going to lose revenue because it brought down our e-commerce site. We may lose customers. That happens right away. We look at the potential loss, what happens right away. Now, delayed loss is down the road. What's the secondary ramifications of this type of attack? So the big thing is reputation. Companies, decision makers within organizations, that's really the big stick, is the reputation. They don't want to end up in the papers because they've lost a bunch of social security numbers or their environment got hacked into. But the delayed loss, that's the losses down the road, would be our reputation. We could lose customers. We could lose new customers that we would have gotten. So it's not just right at the point of when a vulnerability gets exploited. It's what will happen down the road also to the company. Now, I said that security is about cost benefit, and you always have to figure out, because it's security and functionality, because the business has to do its work. You can't stand in front of business, and there's a lot of struggle usually within organizations of what's enough security and what type of processes or risks you have to allow to take place just for the company to keep doing what it does. Now, when we look at the cost-benefit analysis of a countermeasure, we need to make sure that we're not paying too much for something we don't need. Just like when we did the ALE calculations, we come up with a value. If we're going to lose potentially $3,000, we're not going to spend $4,000 for a countermeasure.
Video by Xelmart.com.
Now, remember that we had to calculate the value of an asset, and that wasn't straightforward. There's a lot of things that actually go into the value to the company of an asset. Well, the same thing is with a countermeasure. How do you determine the cost of a countermeasure? Is it what you pay for it? Well, that's one piece of it. It's what you pay for it. It's maintenance fees. It's how that countermeasure could affect productivity. Maybe it slows down productivity. The man hours that have to be involved. So the actual cost of a countermeasure needs to be understood. It's not just revenue. It's not just how much you pay for it. And a lot of companies went through this when they were first putting intrusion detection systems in. You bought an intrusion detection system, you put it in your environment, and you didn't realize all the false positives, all the alarms that were going to go off because you have to properly tune the sensitivity of it. So a lot of companies found out there's so many man hours in maintaining an IDS, and that would go into the cost of the countermeasure. So it's not just what you pay for it. So we're still talking about quantitative analysis, which means we have formulas and numbers. Now, we've talked about the cost of a countermeasure. How do you determine the value of the countermeasure? This means, how do we know this is the right thing for us? How do we know what the value is of this countermeasure? Because a lot of companies, they buy things because it's the new thing on in the market. A consultant tells them they need to buy it, but actually figuring out what the true value of this countermeasure is, there is a calculation for that. That calculation is the ALE before you put the countermeasure in place. What that means is the potential loss before you put anything in place. How much can we lose if a vulnerability is exploited and we don't have something in place? Then you subtract the ALE after you put the countermeasure in place, because the whole goal of putting in a countermeasure is that it's going to reduce your potential loss. You have a potential loss, you're going to put a countermeasure in place, and the goal is to reduce that to your acceptable level. So, and then you subtract the annual cost of the countermeasure, which we talked about what the cost of the countermeasure is. This is a difficult thing for people to understand. I've taught it a lot. It's not overly intuitive, so I want to go through it one more time. You have an ALE, that's your potential loss, before you put anything in place. This is how much we could potentially lose if a vulnerability takes place. And then you subtract the ALE after you put the countermeasure in place, which it should be lower. You come up with that value, and then you subtract how much this countermeasure costs us. That's how you come up with the value. Now, if ALE for a specific asset is $78,000, and then we put a countermeasure in place, it reduces that ALE to $20,000. And the annual cost of the countermeasure is $60,000. Is this the right countermeasure for us? Again, the ALE is $78,000. After we put the countermeasure in place, the new ALE is $20,000. The actual cost of the countermeasure is $60,000. Is this the right decision? Is this the right countermeasure for us?
Video by Xelmart.com.
The answer is no, because we'd be in the negative. In our cost-benefit analysis, we would be spending more for the countermeasure than we could potentially lose. So this is a very good exercise to go through. Even if companies don't do the exact numbers, even if you don't use this exact formula, what's really good is that you understand the value of an asset, all that goes into that, and that you understand when you buy a countermeasure, it's not just how much you're going to pay for it. Those concepts are very important. Now, if you put them in a formula, great, and for the CISSP exam, you're going to need to know the formulas. But a lot of this stuff is very good, even if you understand it conceptually, how to put it in place in your environment. So again, a lot of companies just put in the countermeasures that they think they've heard about, or it's the new thing, or they're not educated or informed decisions. A lot of purchasing is not informed decisions. And again, that's not because people are stupid, it's just that it's hard to know all of this stuff. This is an immature market, and we're all learning. Now, with the control that we're going to put in place for the countermeasure, there's several things that we need to look at, not just how much is it going to cost, but there's a whole list of things that we also need to look at. Is it going to default to least privilege? Is it flexible? Does it provide uniform protection? Is it modular in nature? Modular is a big deal now in the industry, that you can put it in, update it if you need to, and not affect all the systems around it. Does it require human intervention? Means do people have to do something, which is always a bad thing. Anytime people have to be involved, that's when mistakes happen. Auditing is a big thing that needs to be in place. Since we're under regulations, it's become even more important. So does this countermeasure, does it have auditing functionality? Is it usable? Has it been tested? Can we test it? And that's a big, a lot of companies should do some type of bake-offs or test products before they put it in place. Some companies are afraid to ask vendors to get a copy of the product, but they should be able to give you a copy. You put it in the lab and have go through tests to make sure that it's not going to negatively affect your systems or your business functionality. So quantitative analysis, what's the benefit of that? Well, we're able to give management the report in what they want, which is in monetary values, it's in percentages, it's scientific, it's
Video by Xelmart.com.
it's objective. So these are the benefits of a quantitative analysis. What are the disadvantages of this? There's an amazing amount of information or data that you have to gather to properly carry out a quantitative analysis. For example, there are certain tools that are just quantitative, and they'll want you to figure out what is the confidentiality cost for an asset,
Video by Xelmart.com.
integrity cost, availability cost. There's all of these things that you have to figure out or collect. It's a lot of information, very detail oriented. It's hard to carry out manually because there's so much information, and because mathematics are involved. That's usually done through tools. It's not very flexible, and there's no real standard of exactly how it should be done. So quantitative,
Video by Xelmart.com.
there's good and bad about it, but the main thing you need to know for CISSP is what is it, what are the formulas, and what does formulas mean. Now qualitative, what's great about that? Well, you're assigning values. You don't have to gather all this information and do all this mathematical work. You're assigning some type of ratings, high, medium, or low. That's a lot easier. It's much more flexible, and you don't have to go through as much work, really. You have to gather the data, but you don't have to go through all the work that you do with quantitative, with all the calculations and such. So what's the disadvantages of qualitative? It's subjective because it's a gut feeling, it's an opinion. You're not using objective metrics. It's hard to map to a security budget. It means if you go to management and you say, well, this is high and this is low and this is
Video by
medium,
Xelmart.com.
how do they know how to come up with a budget based on that? It's much more difficult to do that. You can't do a cost-benefit analysis because you're not collecting any monetary values. You're not doing percentages, so you can't carry out a cost-benefit analysis. So these are some of the disadvantages of qualitative, but this is the most used in the industry. Now, earlier I said that you can't have 100% security. What that means is you can't get rid of all of your risk. There's different ways of dealing with
Video
risk,
by
but you can't get
Xelmart.com.
rid of all of it. There's a difference between your total risk and your residual risk. Your total risk is when you don't put any countermeasures in place. You know about there's a vulnerability, a threat, but nothing's done about it. That's a total risk. That's what you're faced with. Now, if you do something, if you put a control in place, that is residual risk because you can't get rid of all of risk. So total risk just means if you don't do anything, this is how much you could potentially lose. Residual risk means that if you put something in place, it will reduce the risk, but it won't get rid of all of it. Now there's some conceptual formulas. And what I mean by conceptual formulas is that these are formulas that you're not going to be able to put numbers in.
Video by
They just
Xelmart.com.
explain the concept between total and residual risk. So total risk is the threats, the vulnerabilities, the asset value. That would be total risk. And then residual risk, you take the total risk and you multiply it times the control gap. The control gap is what your control can't protect against, because your control or your countermeasure can't get rid of all of risk. So you could see on the exam these types of formulas. You'll need to know them. The total risk
Video by
would be the
Xelmart.com.
threats, vulnerabilities, asset, and then you could see residual risk represented two ways. Either it lists all of those that I just listed for total risk, and then you multiply it times the control gap, or you could just see total risk minus controls. And so those are something that you'll need to know. But you know, the overall concept is you're going to have to live with some risk. Is it
Video by
below
Xelmart.com.
the actual acceptable risk level? Remember that an acceptable risk level has to be set. What if your residual risk is actually here? That's not good enough. You may need a different control, or you may need another control to be able to reduce the risk. Now, one thing that's not commonly done in this risk program approach is an uncertainty analysis. What an uncertainty analysis is how much confidence do you have in the data that you put into the formulas or the data that you collect? Because some of the data you can know for a fact based on maybe historical events. Maybe you've collected metrics over 3 years and you have confidence in that type of data. Maybe you're actually getting data that you have nothing to base on. It's going on a gut feel. So an uncertainty analysis has to do with assigning the amount of trust or in the information that you're actually using. Because when you take this information, you go to management, they need to understand that you're not going to necessarily lose this much amount of money if you're doing quantitative. It's a guess. We're doing the best that we can on understanding our potential risks that we could run into. Now, there's 4 ways of dealing with risk, and this is not up to the group who just did the analysis. How it goes is you get a team, you identify the assets, you identify the vulnerabilities and threats, you calculate the risks, you come up with potential solutions, and then you hand it over to management. You give them the information. These are potential risks. It's up to them to determine what to do with the risk. It's their responsibility, nobody else's, because they're ultimately liable. So there's 4 ways of dealing with risk.
Video by Xelmart.com.
Mitigation, transfer, acceptance, and avoidance. A lot of companies don't either understand that those 4 ways of dealing is available, or they don't use it. Most of them don't
Video by
understand.
Xelmart.com.
So a lot of times I've seen many companies have have a large consulting company come in and do a big risk analysis and all these pretty pictures and pie charts and everything, and then they do nothing with it because they don't know what to do with it. So you need to know what to actually do with the data you just collected. What do you do with this risk? So if you're going to you put a control in place, that means you're going to mitigate. You're going to reduce your risk. Put a control in place, you mitigate. Now you can actually transfer your risk, which means like buying insurance, which means that this risk is too big to sit on our shoulders. It's too much for us to take on. So there is cyber insurance. There's different types of insurance that deals with anything that can take place and that can negatively affect your revenue. So that's one way, is transferring the risk. Another way is acceptance. You accept the risk. You know about it, you accept it. And really, the acceptance of the risk is when the countermeasure costs more than your potential loss. So that's when you usually just say, okay, we understand the risk and we'll accept it. Now, another way is avoidance. And what avoidance means is you're going to stop whatever is causing the risk. So, for example, if the team has come up with a risk that you're allowing your users to use instant messaging and it's going through your firewall. Well, instant messaging is a way to pass viruses and bad stuff just like any other protocol. So you can choose to accept it because maybe there's a business case that you actually need it. You can mitigate it, meaning that you still allow your users to use it, but maybe you set up your own internal instant messaging server and have it controlled. Or you avoid it. You say there's no business use for using instant messaging, so it's not allowed. So avoidance just means you get rid of what actually is causing the risk. Now, risk acceptance. This, I think, is huge in the industry because most organizations are accepting risk or they've delegated who's going to accept the risk or deal with the risk, and people just accept it. Like when I said that you need to delegate who's responsible for risk, and companies that have the business unit managers or the department heads that are responsible for the risk within their department, what I've seen is a lot of times that department head or that business manager doesn't understand or doesn't have the time or has enough other things to do, and they just accept the risk and they don't understand what they're accepting.
Xelmart.com.
So when you accept risk, it needs to be based on cost, where we did the cost benefit analysis with the control. Pain means that if we allow this risk to exist, how is it going to hurt us? How is it going to affect us? And visibility,
Video by Xelmart.com.
reputation. If we just accept this risk and our customers find out about it, how's that going to hit, how is that going to affect our reputation? And it shouldn't be a surprise decision. You should have a very calculated or a process that you're going through, which is what we're talking about. We're talking about building a whole security risk management program, and you're not just winging it. So this is what we started with, and this is what we'll end with in risk management, where we have to have a team. We develop a scope of what we're to be protecting.
Video by Xelmart.com.
We come up with our method, which is, are we using quantitative or qualitative? We identify the tools that we're going to use. The tools are beneficial because they'll reduce the amount of work we have to do. We have to understand the acceptable risk level. What's enough security? Then we collect the information. We identify the assets. We assign values to those assets. We identify the vulnerabilities and threats. We calculate the
Video
risks.
by
We do
Xelmart.com.
cost-benefit analysis and an uncertainty analysis. And then we hand it over to management. And management decides, are we going to mitigate, transfer, accept, or avoid? And so this is not only good for the exam, this is a very good roadmap to use in a corporation or organization that's trying to set up a risk program.